Hello, dear students. So, in this session, let us understand about scope of financial management. So, previous session we discussed the introduction part, objectives of financial management, and now we are going to discuss the scope. Yes. Why? If we are understanding this financial management, what will be the benefits from our side? Yes. First one is capital structure and planning. See, there is a term called as debt equity ratio. Actually, when we are starting the business, we should know that how much debt that we are going to borrow from outsiders, and equity is something that our own funds. So that ratio, what kind of ratio is it? So we should know that. First one is, it may be, equity, it may be 70% and 30% it may be of debt, or else 60% of equity, or else 40% of debt. So the ratio, it may be in any form. One thing that we need to be very careful that debt should not be more than the equity. Okay, if you are increasing the debt and equity is having zero equity, and if we are simply increasing the debt and we are planning to start the business, it is somehow highly risky. So that is what the structure and planning, how you are going to plan for your business. Next, capital budgeting. So as we discussed already about this budgeting, estimating for the future. See how much requirement for land, how much requirement for building, for machineries, for improving infrastructure facilities, for purchasing of raw materials, for purchasing of, any kind of huge investments that we need to plan in prior. That is what capital budgeting. See, budgeting is also very, very important decision. Basically, in budgeting, there are different budgeting like cash, production, sales, fixed, flexible. There are different kinds of budgets. So that is also, the benefits when we are understanding about this financial management. We can understand that is what is this budgeting. And next part is like financing dish. How you are procuring the finance for the business. How? For what? How much? When? Where? Right? So the reasons for, procuring the finance, how much for all these things, and from where in the sense like from whom, from shareholders or from banks or from public deposits or any other lenders who are ready to offer you, right? For starting the business, for expanding the business. Next, working capital management is something that we can say this as a capital used to manage for running the company, on a day-to-day expenses, to balance your day-to-day expenses, right? So these kind of, expenses, it is not such a huge investment. So within 1 year where you can able to repay that. So very, short, purchasing of raw materials, we can say this as working capital requirements, working capital management. That is what short-term, there is a term called as short-term liabilities. So that is also the another benefit that we can understand from this financial management. The next is dividend. So dividend decision. So after getting the profit, you need to distribute your profit to your shareholders, right? And that profit is distributed into several different portions, and that is actually called as dividends. If that profit is distributed, it will be called, we can say that as dividends. If it is not distributed, we say that term as retained earnings. Next, managing and accessing risk. Yes, as I said, there are two terms, like one is risk, another one is return. So we need to know how to manage the risk, how to assess the risk. There are different risks involved in the finance, right? The more risk that you take, obviously more return that you gain. So it depends upon the business owners whether to go with the risk or not. Next. Yes, there are different risks like market, credit, liquidity. Market risk is, it is something that whether to get into the market, it may be new market or already existing market, it benefits you or not, right? Taking a risk. Next is credit risk, right? Where you are providing your goods to your customers on credit basis. That is also risk. You're simply like giving the goods on his credit worthy, right? Yes, definitely he'll pay the amount. If not, that will become a risk. Next is liquidity risk. How we are going to convert into cash. That is also risk. Next is operational risk. So managing on a day-to-day basis. Everything it is what? Operational risk. It may be high, it may be low, it may be medium, right? And next is procedures. All the procedures that we can able to understand from this, after learning this entire process of financial management, you can able to know that how to prepare financial data, how to prepare invoices, payments, reports, all certain things. Can able to get some clear cut idea on the finances. So this is all about the scope of financial management. Thank you all.